Welcome, everyone. Today, we're diving deep into the world of finance as we uncover the secrets behind reading a balance sheet. A balance sheet is a powerful financial statement that provides a snapshot of a company's financial position at a specific point in time. Understanding its structure and deciphering the numbers can reveal valuable insights into a company's health and performance. A balance sheet is divided into three main sections: assets, liabilities, equity. These sections are represented by the fundamental accounting equation: assets equals liabilities plus equity. This is a fundamental principle in accounting that ensures every financial transaction is recorded accurately, keeping the balance sheet balanced. This equation reflects the financial structure of a company, where all resources, assets, are funded through either debt, liabilities, or ownership interest, equity. First, let's look at assets. Assets are resources owned by a company that are expected to provide future economic benefits. They are typically divided into two categories: current assets and non-current assets. Current assets are expected to be converted into cash or used up within 1 year. For example, money in the bank or other highly liquid assets, cash and cash equivalents, money owed to the company by customers, account receivables, goods available for sale, inventory, prepaid expenses made in advance for services or goods. Non-current assets will provide economic benefits for more than 1 year. Examples of non-current assets include long-term physical assets called property, plant, and equipment, intangible assets, and other long-term investments. Next main component of the balance sheet is liabilities. Liabilities, also divided into current and non-current. Current liabilities due within 1 year, such as accounts payable, short-term debt, and accrued expenses. Non-current liabilities are long-term debt, deferred tax liabilities, and other long-term obligations. Finally, we have equity, which reflects the company's net worth. It includes retained earnings, shareholders' equity, common stock, and additional paid-in capital. Retained earnings show the cumulative profits that have been reinvested in the business rather than paid out as dividends. Now you can see that the balance sheet equation ensures that everything balances out. This means that the total value of the company's assets must equal the combined value of its liabilities and equity. Essentially, what the company owns is financed by what it owes and what the owners have invested. Now you can know how assets equal liabilities plus equity. Accordingly, the balance sheet must balance because of the following two principles: financing of assets and accounting transactions. 1. Financing of assets. Every asset owned by the company is financed either through borrowing, liabilities, or through the owner's investments, equity. For example, if a company buys a piece of equipment worth $100,000, it might finance it with a $60,000 loan, liability, and $40,000 from retained earnings, equity. 2. Accounting transactions. Every financial transaction affects at least two accounts in such a way that the balance sheet equation remains in balance. For example, when a company takes out a loan, cash, an asset, increases, and loan payable, liability, account also increases. Both sides of the equation increase by the same amount, keeping the equation balanced. Now that we understand the structure and main three components of a balance sheet, by analyzing the balance sheet, decision-makers can calculate various financial ratios to determine the level of financial risk the company carries, understand how easily the company can convert its assets into cash, and predict the company's ability to meet its long-term obligations and stay solvent. These ratios provide valuable insights into a company's liquidity, leverage, and profitability, allowing us to assess its financial health and performance. We have more exciting content coming up, including an in-depth look at financial ratios and how to interpret each section to assess a company's financial health. Don't forget to like, comment, and subscribe for more financial insights.